AccuVest Global Advisors. I'm the CIO here, and welcome today's market conversation about a pretty important and popular topic, AI and ancillary AI around the power grid theme. Just a reminder, this podcast is for information and educational purposes only. This is not financial advice. Please do your own research. It is Tuesday, July 28th after the market closed. I'm excited to talk about the whole stack, AI, technology, semiconductors, energy transformation. Maybe we'll even talk about the CapEx cycle and some of the madness that's happening there. But my guest today is Managing Director at TCW, Eli Horton, and the Portfolio Manager for Thematic Equities and Durable Growth Equities. Eli was MD at Maverick Capital, a hedge fund that we know pretty well and follow. Very impressive group over there. Eli was also at the PE firm KKR and Goldman Sachs, where he focused on tech, media, and telecom. So thanks, Eli, for joining me today. And there's obviously a lot of things to talk about. Never a dull moment in the casino, but really appreciate your time.
Not one single dull moment. It's good to be here. Thanks for having me.
Absolutely. Just so for the listeners, I want to make sure they understand, TCW is the asset manager. You run a couple of strategies, one of which we're going to talk about today is the TCW Transform Systems ETF, symboled powered, PWRD. And just a reminder, we're an RIA. We're about $1 billion in assets. We did a ton of research. We are thematic in nature. And this theme was one that we really wanted to get some exposure to. We did a bunch of pretty rigorous due diligence and found your ETF. And the February 3rd, 2022 is the inception. That's my mom's birthday. That's interesting. Annualized return over 20% for that 4+ year period versus 13.4 for the S&P, even 16.5 for the Nasdaq 100. Obviously, has been an outperformer over a long period of time, and importantly, versus 15.9% for the pure industrials ETF as well. So well done, man. I mean, it's been a wild ride, not without certain sell-offs and hiccups along the way, but to do 20% annual returns over a 4-year period, that's pretty impressive. And our clients, certainly really appreciate that.
Yeah, appreciate it, Eric. It certainly helps to be in a large theme with a strong tailwind. I think that is certainly an enabler of growth and hopefully more good performance to come.
Absolutely. Well, let's jump right into it. Let's start big picture. What makes the approach to investing in energy transformation different from how maybe most investors might think about the space? Let's just start super broad and then get down to the ETF.
I do think we've got a slightly differentiated view on what the energy transition really is compared to what most folks think of, or even what some investors have employed. We think of the energy transition as sort of this collision of sort of 3 key factors. One, the world needs a lot more energy security. It's become a priority for corporates and for governments. That's being very heightened by what's happening in the Middle East right now. 2, we believe we're re-entering a period of structural growth for electricity and power demand. I know we'll talk a lot about that. And then the 3rd factor is ongoing efforts to decarbonize the global economy, to migrate from fossil fuels to a global economy that's built on lower carbon sources. So energy security, growth of electricity and power, and then decarbonization. That's how we define the energy transition. If you add up those 3 pillars, it's approaching $5 trillion of capital investment annually to impact this change or to impart this change. That capital is being received by a lot of old economy companies, and so that's the area that we focus on to invest in this thesis.
Now, I mean, forgive this question, but was this really a real big theme before AI, or was AI just kind of the icing on the cake that really kicked this important theme in the modernization and upgrades into high gear?
So I think the answer is yes. It was definitely a theme before AI. although it's become much more topical and in the news now with what's happening in AI. So go back to those three pillars. So energy security has been a meaningful investment priority for the United States for several decades. So we're now a net exporter of energy. That's new. So we're now energy secure. Europe has gone through fits and starts here, but the Russian invasion of Ukraine really impacted net gas flows, and Europe has started to invest very heavily in energy security. So that's been there. Decarbonization, that can at times be policy driven, and so the pendulum can swing. But that's been present, and I think this power and electricity growth component really has accelerated, but it's multi-pronged, right? AI is a portion of that, but we also believe that there's broad-based electrification taking place in our economy. We're bringing manufacturing back to the United States. That's very electricity intensive. So I'd argue that the opportunity set can move around within the theme, but the theme has been present, I think will be present for quite some time.
Okay. I mean, from a sector perspective, I mean, when you say energy, obviously you think traditional energy. This feels a little more, industrial at the core. So when you look at and I know that you have flexibility, and that was one of the things that we wanted. I don't. I've been stuck in a theme before with a manager that had no flexibility to
Yeah.
navigate troubled waters. So you always, I personally think it's important that your managers have some latitude to kind of navigate any potential volatility that comes. But I mean, at the sector level, what can people generally expect from Powered?
So let me answer this two different ways. So first of all, the universe is fairly large. There's about 1,200 companies that we define as enablers or beneficiaries of the energy transition. Those 1,200 are predominantly in the US or North America and Western Europe predominantly, and they tend to be fairly large scale businesses. So it's a large universe from which to source ideas from. We run a concentrated strategy, 20 to 30 investments in the portfolio most of the time. So think of that as maybe 2% of the investable universe. So we try to find the winners within this team. So that's one way of looking at it from a sector perspective, which I think can sometimes misstate the opportunity, but I do understand the usefulness of that definition. It tends to be kind of 60% industrials, and that remaining 40% gets mixed around between materials, energy, semiconductor, and services predominantly.
Okay. Okay. I mean, let's turn to the crazy market we have. I mean, for the most part, all of this kind of tech and the AI trade had really long tentacles. It reached into industrials, it reached into utilities. In some degree, it reached into semiconductors and certain parts of technology. And, up until recently, when that whole crowded, that trade got a little too extended and crowded away from long-term averages with lots of leverage, and now we're seeing some of that unwind. But I mean, talk to me about where you are on portfolio positioning today. Yeah, particularly given we have a lot of geopolitical developments that are happening in the Middle East.
Yeah.
We have, so we're now questioning some parts of the AI trade, and maybe because of that, we're questioning the need for power. Or is this just an unwind of very crowded positions that were all linked together in baskets that, unfortunately is less about fundamentals and more just about, mechanical type of positioning?
You probably didn't mean to, but you kind of just led the witness right there, or at least you gave me the perfect segue for where I was going to go. So we really try to stay close to our first principles at all times. I think there's a ton of distractions in the world, but at first principles, we're trying to develop a differentiated view on a company and then assess if it may be mispriced. And you kind of talked about right at the very end there how this has not been really driven by fundamentals, and there's a lot of other factors at play. And I would agree with that. I would write that in big font, bold, underline. Like I massively agree with that. There's so many considerations. There's the levered ETF dynamics in South Korea, where I believe the single stock levered ETFs were 30% of the ETF market, which is kind of crazy. We've seen a number of issues with the war that's going on in the Middle East. Obviously, AI CapEx debates drive stocks much more than the fundamentals, I would argue, of the companies that receive that CapEx. But at the end of the day, fundamentals have been quite strong. We are in the very beginning of earnings season. GE Vernova, which is a business that we've owned in size. It's a little smaller now, but we still own it. They reported tremendous figures last week. We own Bloom Energy, which is it's a roller coaster. We're okay with that. They just reported maybe 40 minutes ago or an hour ago. Fantastic numbers, far better than even we expected. Fundamentals are quite robust, and we really have to anchor to that and try to ignore some of the noise sometimes. I think that's a very important thing for us to do and how we can add value to our investors.
Talk to me about from evaluations, because I mean, I personally went through. I was a young pup in the late '90s and was watching some of this firsthand as working for a value manager at the time, and shaking my head. And so, now you have companies with great fundamentals with absolutely enormous backlogs, yet valuations were a bit stretched too. So I mean,
Mm.
certainly if I didn't know you really well and I just looked at your resume, it would scream having some sort of a value bias. KKR, Goldman Sachs. I mean, talk to me about the valuations relative to the growth. Maybe the pegs are really attractive, but how do you use the valuation part of that? Because it's not a very good timing tool, but it is certainly a good gauge of how much is built into a stock price, even if the fundamentals are about as good as they ever get.
So I will say that, in hindsight, it does seem that some of the valuations got a little bit stretched. You can see that pretty clearly in the market. I've found that the best the best thing for me to do as a portfolio manager and investor is to make sizing decisions, but not make exit decisions on valuation if you have a truly great business. The best businesses, and let's just talk GE Vernova, because this is something that we had reduced the size of it over the past couple of weeks based on expected IRR, and I'll talk about that framework. But this is one of three companies in the world that make large-scale gas turbines. We think they actually have the best turbines and the dominant position in the U.S. market. So not only are they one of three, we think they're the best of three. I think Scott, the CEO, is a tremendous capital allocator, and they have a number of growth avenues that we probably can't even foresee, like take their small modular reactors on the nuclear side that we basically give them no credit for. But if I had to guess, I think they might be the winner in that race. They're gonna they're gonna create value that we just can't get our minds to imagine all the time. We think linearly as people. And so I have this bias to let great businesses run. Now, at times you might end up with, GE Vernova trading off from peak 25%. I tend to look at that as a buying opportunity.
Got it. Okay. So let's move into some smaller verticals within this. Let's talk a little bit about nuclear. Obviously, it's become front and center whether we can do it, will do it, can do it in without so much red tape that it becomes decades. I mean, it seems like nuclear is a very important component, and we'll let the politicians, kind of duke that out. But talk to me about that particular opportunity within, the portfolio, or
Yep.
if you're looking at stuff inside of there.
Yeah, look, we're short power in the US, full stop. We have demand that cannot be fulfilled by the supply side. And you can only get power from so many sources. You can get it from coal, but we're not going to build new coal plants, so throw that out the window. You can get it from nuclear. Nuclear is carbon free, but it takes 7 to 10 years to build a new plant. You can get it from wind and solar. They're intermittent. They need batteries. Batteries are super expensive. So there's issues on the wind and solar side. You can get it from nat gas. Nat gas is now sold out for the next 5 years. So really, nuclear is the only other thing that you can slot in there. It's carbon free. It's energy secure. It doesn't rely on any sort of foreign cooperation. There's a lot of demand for nuclear. There's 95 reactors in this country. We haven't built any we've built three in the last 25 years. There's 20 that are in active review to be built, and they're going through the review of the equipment they need and the site selection. We think nuclear is going to be a critical source of solving for this power scarcity issue. The large scale nuclear side is where we're most interested. I think small modular reactors, which you mentioned, will play into this, but they're not going to be as needle moving as the large scale side.
And how do you play that? I mean, is that a Kamiko or how do you
There's
do
a few
that?
ways. So there's businesses that own existing nuclear power. You could have a thesis, and we have in the past, that those nuclear power assets will re-rate in terms of the price customers are willing to pay because of the always-on carbon-free nature. I think the volume side of nuclear is more interesting. There's a couple companies that I'd highlight. One, you mentioned it, Cameco. They have a couple parts of the business. One is equipment through their stake in Westinghouse. And then the second is, they have a uranium processing business. We think the uranium market is structurally tight, structurally short. Spot prices are supportive of that view. Contracts are being reset. So that's more of a uranium and equipment side of things. Then a business that probably most folks haven't heard of is a company called Mirion Technologies. This is a little different. It's less of a CapEx oriented revenue stream and more of an OpEx business. So Mirion provides radiation detection systems. They're on 95% of the world's nuclear reactors. If you go into one of those facilities as an employee, you're going through like one of those TSA screening checks, but it's for uranium or for any sort of nuclear hazardous chemicals. Um, so they've got all of that. They've got sensors on the core, and they get paid on spares and maintenance work. And so it's this recurring revenue model on a nuclear plant. Nuclear plants run for 80, 90 years sometimes. So it's this long visibility, predictable growth business. And now they're seeing an acceleration because we're having nuclear plant lives extended, and we're going to build new plants.
Total sidebar, but is Kamiko spinning off Westinghouse? Is that
No, they own
rumor or is that fact?
no, they own 49% of it, and then Brookfield owns
Okay.
the remaining piece. So which is actually like
Okay.
strategically great because Brookfield has, the infrastructure focus. So for example, Brookfield invested in a plant called BC Summer. It's on the Atlantic seaboard, and it's a nuclear plant that was started and then stopped a long time ago. So it's just sitting there, like partially built. Brookfield's going to rebuild it, and they're obviously since they own Westinghouse, Westinghouse is going to get the equipment contract.
Got it. Got it. Well, let's talk about how the hot potato of late fits into this whole scenario with semiconductors and semiconductor equipment. Why do those kind of businesses belong in an energy transformation portfolio? What's the broad thesis there?
They hit it from two sides if you think about it. So go back to what I said about what's driving the thesis: energy security, broad-based electrification or demand for electricity, and then decarbonization. Semiconductors kind of fit into all of those, and maybe the most strongest into the second two. So if you think about what's driving decarbonization, what's driving more electrification, everything has more semiconductor content. So an electric vehicle has 3 times the amount of chips as an internal combustion engine. The factory of the future, we're building new manufacturing in the US now. It's massively automated, it has a ton of chip content. So they're key enablers, but they also are creating some of the power growth and some of the issues on the supply side. So AI is driving, just on its own, is driving over 1% electricity growth to the total US system. It's driving the need for 130 gigawatts of new data centers to be built by the end of the decade. 130 probably means nothing to most people, but New York City runs on like 6 gigawatts. So 20 times the size of New York. So semis are enabling, but also kind of creating the electricity demand piece. So they really fit right down the middle of the fairway for us.
So give us an idea of some of the names that is that the Nvidias and the Broadcoms, or are we talking Applied Materials? Like
Right.
what
Right.
part of that chain, or maybe all?
So I suppose all of it's theoretically investable for us. Well, I have a natural bias to look for businesses that are particularly high quality and ideally sit in a bottleneck, because if you think about everything that's happening with the energy transition, we're talking about atoms, not bits. Like, this is physical things are happening. We are building more factories. We're building grids, substations. It is It is creating massive strains on industrial supply chains, and semiconductors kind of fall into what I call an industrial supply chain. So where there's bottlenecks in the semiconductor value chain, I think are particularly on the equipment side. So Applied Materials has been a large investment for us for most of the inception since the inception of Powered. KLAC is a large investment. We have not owned NVIDIA. We don't own any Mag 7, to be honest, and that's less of a strong stance on the Mag 7, but more that we just think there's really interesting opportunities away from them.
Yeah. The kind of buy the scarcity then and sell the free cash flow degradation.
Yeah, no, 100%. Like we'd rather follow the cash flow. And in the semiconductor ecosystem, where's the value get captured? It gets captured where there's really great industry structure. So look at Taiwan Semi. So we own that business too. If you go back to the past cycle, their gross margins hit 60%. Now their operating margins are 60%. And the business is cyclical. We're eyes wide open to that fact, but they have very little competition. Same thing for Applied Materials and KLA. They have maybe one or two competitors. These companies extract economic moats, they extract returns from the value chain. So we prefer to go there rather than own the long tail suppliers where it's more, hand-to-hand combat. You never know if they're going to win or lose. And if you time it right, great. But timing's a tough thing to do. So we really prefer business quality.
Got it. I mean, I personally think quality is really important at this part of the cycle.
Yeah.
You come out of a recession, it's okay to buy highly levered businesses that somehow made it through an economic slowdown, but that's not really where we are. So, one thing that I think most advisors want to hear is that there's a quality bias. Another thing that they want to hear, and I've been working with advisors for 30 years, and we're advisors ourselves. I mean, talk to me about the flexibility that you have in the prospectus and maybe how you've used it over the last 4+ years. I mean, is there any particular things that jump out at you for that?
100%. So we have a universe of 1,200 businesses that we can invest in. So that creates some inherent flexibility right there. This is important to me too, as an investor. And you mentioned that I worked at Maverick, which was an incredible experience. I'm grateful for that opportunity to spend 8 years there. That firm's track record speaks for itself, but we invested in a very concentrated portfolio. And so I'm a deep researcher, stock picker by background, and you need to have some size of a universe to be able to employ that philosophy into. So we have 1,200 businesses. Over time, we have made changes to the portfolio that hopefully have added value to our investors. So if I go back to 2022, we had about 30% of the portfolio invested in oil and gas. Go to 2025, we had almost none of the portfolio invested in oil and gas. And today we have about 10%, largely through our LNG investments. So you can see that's one piece that moves around. We have our semiconductor investments have oscillated through time. Same with our grid investments. So we will move capital around where we think there's the best opportunities. We have this concentrated book, but we really do seek to have businesses that have high expected IRRs at the top of the book, businesses that have asymmetry and dollars up, dollars down, and then the top of the book will always be a more quality business. That's something that's just a non-negotiable for us.
Kind of put on your forecasting hat a little bit, look out 3 to 5 years, how do you think this AI evolution plays out in the power grid upgrades and modernization that needs to happen anyway? Where is this CapEx coming from? You said 5 trillion earlier. You've heard Jensen Huang talk about the trillions in technology upgrades that need to happen. And we got defense sector that has 3 trillion in spending. Like there's a lot of trillions being thrown around. So I would argue keeping the lights on is probably one of the more important things to spend on. But talk to us about kind of when you're managing a portfolio for right in front of you, but you do have a mind in the 3 to 5 years and how things will play back over time. So talk to us about that, because I think that'll help us frame also how to use
Yeah.
powered in a portfolio.
So I think, yeah, and look, just as far as the powered portfolio piece goes, our thesis around or our investments behind the great expansion and power scarcity, that's about 40% of the portfolio. If you count semiconductors, it's a little bit larger than that, but it's certainly not all of the portfolio. Um, we seek to have a broader mandate than just that. Going back to the question, I think the market's probably underestimating both the magnitude and the duration of AI CapEx, but even more so of grid CapEx. There's a bunch of ways we could cut this. One, if you go back 3 years ago, utility CapEx was about 200 billion in this country. There was no load growth happening. That's all maintenance CapEx. Now we're seeing electricity demand grow 3-4%. So we need to add maybe another couple 100 billion for each point of growth. So now we're approaching just utility CapEx. The grid could need potentially $1 trillion soon. That's all going to transformers, to turbines, to high voltage cable lines. These companies don't have the capacity to meet that demand. So GE Vernova just said they're 50% sold out in 2031. They can't build these turbines fast enough. And their backlog is definitely secured by capital from customers. So I think the market's probably misunderstanding the demand side. We have a view that the supply side just won't be able to keep up. And that just means these bottlenecks are going to persist for a much longer period of time. Now, sentiment will oscillate. We're in one of those moments right now. I think that things like the NIMBYism and the moratorium on data centers is absolutely catching a lot of headlines. I think if I had a crystal ball, I would guess that could persist into the midterms. But when this happens, stocks dislocate from fundamentals. We did this analysis where we looked at a basket of AI picks and shovels. And since 2023, it's had 13 drawdowns north of 10%, and several of them are more than 20%. But along the way, the index is up multiples. So you have to kind of zoom out and assess the forest for the trees at times. My best guess is we're in one of those moments. Tell me when. Ask me to call when. No idea, but we see what's happening on the fundamental side.
Well, I mean, I think that's the most important, part. I mean, we'll talk to clients and they'll say, "Holy smokes, there has been a lot more volatility than A, I thought there was going to be, or B, that I prefer." And you have to remind people that the price of admission for elevated returns is more volatility. And sometimes in really crowded markets, and I don't love the fact that equity markets have become more casino-like and gambling focused and short-term focused anyway. But that is one of those things that you can't fight. You have to trade the market you have, not the one you want. But the big picture, it's really important to not lose sight of the big picture. Now, so talk to us about like what could go wrong. It's always good to know what the bull case is for something, and then what the potential, bear case, even if it's a shorter term bear case, like what could derail this, aside from maybe the midterms and a lot of rhetoric talking about we're protecting you from AI, and we know your power costs are going up, and we're gonna push those costs to somebody else. But I mean, big picture, structural, what could derail this, if anything?
Right. Let me just say, by the way, on the volatility piece, because volatility, no one loves volatility. When I was at Maverick, Lee Ainsley's the founder. He had this rule for first year analysts where you didn't get a Bloomberg. And I think it's so smart because you see the red and the green flashes every split second, and it's a big distraction. There's rarely value to be added from the information that's just flashing at your eyes from that screen. And he wanted us as analysts to really focus on first principles, have a differentiated view, and trust that stocks will follow fundamentals over a long period of time. The other thing I'd say, elevated volatility, and there's a low amount of correlation right now. That means high dispersion. That's a really good dynamic for a stock picker. So I do think it's a good environment for that. What could go wrong? Look, the thing that I'm probably watching the most right now really is what I mentioned earlier, and some of this NIMBYism on data center construction. So we saw New York put a 1-year moratorium. There was an article 2 days ago, I think, about Loudoun County in Virginia, looking to potentially put a moratorium on data centers that are further out. 2028 is already booked and done, but beyond that, I don't think they can do that without going through like a state legislature process, and I don't think it's really realistic. But that rhetoric is getting louder, and we've seen, positioning around that dynamic going into the midterms. What do I think that could do, in a risk case? I think you could see challenges with certain markets, and a lot of this construction being directed towards markets like ERCOT in Texas, where they're much more willing to take this business. I think there could be red tape put out there, delays in permitting, more hearings to build a data center, and that slows down the whole deployment. That's one that we're looking for. Um, we're pretty we're really quite confident in the return that's being generated from AI CapEx. That seems quite clear. Even when you analyze the hyperscaler numbers, you can see it in AWS and Google Cloud. So we're quite confident on the demand piece, but I think the supply is where there are some areas to watch.
Why do you think people are, if you're quite confident and you're really prepared, why do you think people are real? I mean, there's a lot of high profile people coming out and saying, these ROIs aren't going to be there. The massive amount of capex, they're never going to get this capital back in a return that's meaningful enough to make the spend worthwhile. I mean, to me, these are really smart people that are pretty solid capital allocators. They have a pretty good history of making sound decisions, even if in the short period of time, like let's take Amazon, they've had a bunch of capex cycles together, and the stock tends to lag, and then it tends to play catch up when you monetize that. But it feels like more so than ever, people are critiquing the actual ROI. Is it just because they haven't seen it yet, and so they can't run the numbers, or what do you think there?
I think you can see it. If you look at the incremental capital that the hyperscalers are putting in and look at the operating profit growth of their cloud businesses, you already get in year one a double-digit return on capital. And that's year one. So I think you can already see it. Now, where we need to see it next is at the enterprise adoption level. Enterprise AI, which our semiconductor analyst is quite positive on, and I agree with him. That's what we really need to see adoption to give greater confidence, I think, for the market. When that happens, that's going to happen in an agentic AI world, and that's when you see token demand explode. And I think then the bottlenecks actually can get even worse.
So if the bottlenecks get worse, so there's a lot of demand, and I hear it on, ServiceNow's conference call. You heard it on SAP. There's clearly a lot of demand from corporate America and from consumers to get access to these tools. And if you're a company, to get a lot of the efficiencies and productivity that could be generated. So if there's a lot of demand on one side, but there's a power constraint on the other, does that just push the demand back at the corporate level from really getting the benefits? I'm trying to figure out how the whole thing ripples if it starts with a power issue.
You're talking about the power to actually run these data centers?
Yeah, if there's a bottleneck there, it's going to ripple back, right?
Yeah, I think I'm not sure that'll impact demand. I think demand will get pushed out because you can only meet so much of it. When that happens, I'd rather own the companies that sit in the bottleneck.
Absolutely.
That's the companies that take price. So that's where I'd like to sit.
Okay.
That's why we love this infrastructure layer. And by the way, I'm not sure it does it justice to only focus on AI capex. Like if you believe, as we do, that electricity demand grows several percent for the next 25 years, AI is probably 40% of that electricity growth. The other 60 is bringing manufacturing back. We sent about a third of our manufacturing base to China over the past 30 years. So that now comes back. And then there's a lot of growth from just broad-based electrification, the buildings that we're in, EVs, et cetera.
Okay. Just lastly, from a picks and shovels perspective, what parts of that area get you more excited? We've all heard the stories of the real winners aren't really the people spending all the money. It's the
Yeah.
people that are building the picks and shovels to allow anything to happen. So, give us an idea of who those kinds of companies are.
It's Levi Strauss, right? They're the original picks and shovel.
Exactly.
Yeah. Yeah. Look, I think it's these old economy companies. And part of the reason is that, the industrial market in the US, the manufacturing market in the US really had like the 20-year cycle working against it. We moved manufacturing overseas, capex to sales ratios going back to just 2023, we're like at 20-year lows. Now it's obviously gone up. But there wasn't a lot of capacity in these industries, and a lot of companies got acquired, went bankrupt, and so there was consolidation that took place. And now you're left with fewer companies providing the picks and shovels. Look at data center cooling. Vertiv is now kind of a household name, but they have less competition on the electrical side than they would have before. I think a business like Eaton fits this really nicely. We talked about GE Vernova. There's quite a number of industrial businesses that sit there that are the picks and shovels. They're the enablers. They're providing the equipment that's critical. They're providing the power solutions that's critical. That's really where we like to play.
Okay. And I'm just looking at the holdings. And by the way, I don't know if this is dated, but it says you're about 5.5% in cash. Was that just a recent sale of a couple of things and you're waiting for the right time to deploy things? And then I was just going to mention the number of names that I see just in the picks and shovels just off the top of my head.
Yeah, we typically run cash a little lower than that, like 1% or so. We had
Okay.
we had trimmed a few names last week going into earnings where, our expected IRRs were a little lower, and I've just been a little slower to deploy it, but it'll get deployed. We don't like to swing cash around much.
Got it. Okay. I mean, listen, for advisors, advisors are going to listen to this call. One, the question is always, how do I use an ETF like this in a portfolio? And I'll just, everybody's different, but I'll tell you how we use it.
Mhm.
We have this core portfolio. Some of it's a little active and some of it's a little passive. So we get broad exposure. And then around the core, we think about the themes that we think are really enduring. And that's how we're using Powered. It's how we're using the military modernization theme as well. And so that's certainly a big part. And the nice thing for advisors, you're getting, and I don't have the sector weightings, but you're getting a good slug of industrials, some good energy exposure, a little bit of technology exposure. So you're getting a bunch of things all in one ETF, which is great because the average advisor only has X number of tickers in a portfolio. So if you can get a bunch of different themes all in one ETF actively managed, that's pretty compelling. And at least that's what we thought.
Yeah, that's how a lot of our clients, construct their portfolios and where we fit. I agree with that. Look, I think there are some really important themes that are going to persist for decades. You highlighted two, defense modernization, I fully agree with, and then energy transition. I think there's others. AI is obviously on that list. I think you have to have capital invested in these teams as investors. So then you have the question, do I invest passive or do I invest active? I'm biased, obviously, but I think passive doesn't even make sense to me in a theme because there's so much change taking place so quickly that why would you want to just kind of blindly hang on to an index? My view, I'd much rather find a team that you trust that has their ear close to the ground, that's thoroughly researching these value chains and has a view on that change. So anyways, that's my view. But most of our investors use us, in their portfolios kind of similarly to how you're thinking about it. I think that's smart.
Well, I guess you got $1.5 billion of assets that's agreeing that this is a strategy that makes sense. It's clearly done well for people, and now people are getting this theme and a few others on sale. I mean, if you had to just to end this conversation, I mean, you've been an investor for a long time. I used to trade for a living, so I look at some of the when things are selling off, I like to look at, sniff capitulation.
Mhm.
This morning in particular in the semiconductor category, it reeked of margin clerks tapping people on the shoulder and saying, "You're out." It just kind of had that dump at the close or at the open, and then you had the higher quality names were the first to rebound. So looking at your names the way you know them, have they come down enough where obviously if you're an investor for 5+ years, yes, they've come down enough. You want to put some money to work and probably do it slowly. But I mean, the people who manage portfolios, particularly active managers who know these companies really well, are usually the best to opine on, oh my goodness, what the price that I saw GE Vernova today. Oh my goodness, Eaton. Oh my goodness, any view on understanding that's hard to time the bottom in anything. When you look at your names, what have you been saying the last couple of days?
Oh, I've actually spent multiple hours on the phone with my analyst today because I'm starting to feel greedy. I think the pendulum was quite greedy a month or two ago, and now it's shifted somewhere over to fearful. It can get more fearful, but it's definitely that direction. And this is when I prefer to zig because I can see the market zagging. And what you'll see is, in the portfolio right now, we've got about 30 stocks. I like to start to concentrate our capital into our best ideas in times like this. And historically, that's been a good thing for us. I think we'll continue to follow that fact pattern. Um, we have businesses that are growing earnings 40, 50% a year, and on our 2-year numbers, they're trading at low teens multiples. So I'm starting to get quite interested here.
Okay. Well, that's good because we're going to put some more money to work in Powered. So that was obviously as self-serving a question as it was for the audience that'll be listening to this. But listen, man, I really appreciate you taking the time. Our clients are really going to appreciate this conversation. If you're an advisor listening, you should take a look at Powered, take a look at TCW's suite of products. You do manage a couple of other ones, so just if you wouldn't mind, just tell us about the other ones, just
Yeah.
so if somebody has another need, maybe some of the other ones might suit you too.
Yeah, 100%. So TCW, we manage a suite of well, a lot of different things. $200 billion asset manager, but we just started our ETF business a few years back. It's grown to be about 7 billion across 12 ETFs. Some of those are fixed income. On the equity side, I manage another thematic ETF, which is involved in the reshoring of manufacturing. Reshoring is a very long dated thesis, very large. That is, you can look at that under the sub ticker SUPP. We also have another thematic ETF. I don't manage it. It's been around for 10 years though, and it's AI based thesis. Ticker's AIFD. It's done quite well. And then we have a durable growth strategy that I manage as well. Not a thematic, more of a defensive growth portfolio. So those are the lineup.
Fantastic. Well, if I road biked, I would love to come road bike with you in the beautiful mountains, but or maybe I'll just drag you out on a mountain bike. I mean, if you
I'll
like road biking, you probably like dirt too.
I'll take you up on that. It's more scenic in the mountains. I'll take you up on that anytime.
100%. Tahoe is my favorite place in the whole wide world. I
That's
wish I
special.
still lived there.
Yeah, it's special.
Eli, super, super thankful for your time and appreciate all you've done for clients in the portfolio. And we'll chat again. And I'm sure, buying good businesses when they go on sale, that's a pretty timeless investment approach. That's certainly one that we have. And when I have some people that are calling to say what to do, those are usually good signs I should be putting some money to work. And that's kind of the way we feel today.
Definitely agree. Thanks for having me, Eric.
Yep. Good to see you.